this Employment Taxes Update session, which forms part of the RSM annual Social Housing Seminar Series for 2021. I'm David Williams-Richardson. I'm a Specialist Employment Tax Partner within the RSM Social Housing team, and I'm joined today by my colleague James Wybrow, who is an Associate Director in the RSM Risk Assurance Services team. In terms of agenda for this session, I'm going to start with a high-level overview of the implications and obligations of the new off-payroll working rules that will apply from 6th of April 2021. I'm then going to summarise the employment tax considerations as a result of home working and finish by flagging a few employment tax hot topics. I'll then pass over to James, who's going to run through some observations in relation to the Apprenticeship Levy. So let's start with the off-payroll working rules from 6th of April 2021. Firstly, what is IR35 and off-payroll working in the first place? Well, in terms of background, the original IR35 legislation was introduced with the broad intention of ensuring that workers who are in effect disguised employees, but who decide to provide their services via structures such as personal service companies, should broadly be paying the same amount of tax and NIC as an employee doing the same job. It's important to note at this point that whilst we frequently refer to personal service companies or PSCs when talking about this legislation, it can also apply to some partnerships and even individuals, but it's predominantly focused on personal service companies. A personal service company for these purposes is broadly a company where the worker has a material interest in the intermediary, which is defined as beneficial ownership of 5% or more of the ordinary share capital, or entitlement to more than 5% of any distributions. Finally, it's really important to emphasise that these new rules that we're talking about today apply where the workers' services are provided through an intermediary such as a personal service company. There are separate existing rules that need to be considered where you have an arrangement for the personal services of self-employed individuals. It's also important to note that the off-payroll legislation takes priority over the construction industry scheme. So what is changing from 6th of April 2021? In summary, the new off-payroll working rules will apply to medium and large businesses in the private sector, including those with charitable status, for services provided to you on or after 6th of April 2021. The rules will not apply where the end user of the services is a small private sector business, and I'm going to talk through the qualifying criteria for small businesses shortly. Under the new rules, the company that is using the workers' services will need to assess each arrangement and decide whether or not the worker will be deemed to be an employee if they weren't operating via their off-payroll or intermediary structure such as a personal service company. The end client must then provide a status determination statement applying reasonable care, setting out whether or not the rules apply and the reasons for reaching that determination. The end client will also need to put in place an appropriate status disagreement process. It's important to note that the business using the workers' services will need to provide this status determination statement both in situations where you contract directly with the personal service company and also where you contract for the personal service company workers' services via a third party, such as a recruitment agency. The determination statement will need to be provided to both the worker and the agency where applicable. Where the end user of the services concludes that the rules do apply, then the fee payer, ultimately paying the personal service company, will need to account for tax and national insurance, including employers' NIC at 13.8% via the payroll system. The fee payer paying the personal service company may be the end client for direct engagements, or it could be an agency or other third party, depending on the particular arrangements. It's important to emphasise that this new legislation only applies to medium and large businesses in the private sector, whereas the rules apply to the public sector regardless of size. An exemption from applying the rules applies where the end user client qualifies as small, based on the Companies Act definition, which is broadly where a company meets at least two of the following three tests. Firstly, it has a turnover of 10.2 million or less. It has 5.1 million or less on its balance sheet, and it has 50 employees or less, and this is measured by the average number of employees in the year. If you as the end user client are deemed to be small, then the old IR35 rules will continue to apply, meaning that the worker's personal service company will remain responsible for self-assessing and applying IR35 where necessary. To avoid confusion, the legislation includes provisions to enable the worker or an agency to formally request from you whether or not you are small for these purposes, and you will have 45 days from the date of receipt to respond to that request. These tests are considered for the financial year that is relevant to the tax year, and broadly the financial year that is relevant to a tax year is the one that ends before the start of that tax year. For those companies that are close to these thresholds, this criteria is going to need to be carefully considered on an annual basis. It's also really important to consider the rules carefully before assuming that you do qualify as small. For example, if you have a construction or maintenance business, which is a subsidiary of your parent company, then it's necessary to consider your parent company's aggregated accounts position. If your parent company are not considered small, then neither will you be. It's really important to emphasize that these new rules will put obligations on you as the end client, even where you source an off-payroll worker via a third party, such as a recruitment agency. The only exception to this is where you get confirmation from the recruitment agency that they or another agency further down the labour supply chain are paying the worker via their payroll and are making full PAY and NRC deductions as required. Where you have not had such confirmation, then you're going to need to assess each worker provided by the agency and issue a status determination statement to both the worker and the agency that you contract with, giving the reasons for your determination. If you've determined on your determination statement that the rules do apply, then the agency as the fee payer will need to operate PAY and NRC through its payroll. It's important, therefore, that you have dialogue with the agencies that you work with and identify all workers that they are supplying who are not currently being subject to PAY and NRC by the agency's payroll, who you expect to use after 5th of April 2021. Finally, HMRC are also keen that you as the end client do your due diligence on the labour supply chain, and to encourage this, they've introduced potential debt transfer provisions that can apply in certain situations. As I mentioned earlier, this new legislation will start to apply for services provided from 6th of April 2021, giving you very little time now to complete your preparations. In terms of suggested next steps, we would recommend that you take into account the following key considerations. Firstly, consider your resource requirements, and in particular whether or not you're likely to need off-payroll workers, including those sourced via third parties such as recruitment agencies and those operating via the Construction Industry Scheme from 6th of April 2021. As part of the above, it's important to ensure that you're linking in with other areas of your business, both in terms of checking resource requirements and to ensure that those who will play a part in ensuring your compliance are fully engaged. Once everyone's in agreement, it's going to be necessary to agree and ideally document step-by-step processes and procedures. And finally, you're going to need to make sure that there are provisions in place for ongoing review. I now want to turn briefly to some points to consider in relation to home working. Obviously, COVID-19 has had a dramatic impact on the way we've all worked since March last year, and it seems likely that even when the pandemic is over, there will be increased demand for home working and changes to the way we all work. As a general point, it's important to consider both employment tax and employment law implications before finalising any changes. And it's also important to ensure that you have a clear and documented policy and make it clear as to whether the agreement to work from home is a temporary arrangement as a result of COVID, or whether this will be a permanent arrangement going forward. I now want to look at home working from an employment tax perspective, and very broadly, a home worker will fall into one of these three categories shown in the green box on the left-hand side of this slide. Whatever category a worker is in will dictate the tax position on expenses relating to home working. The first category is where the home working is an objective requirement of the role and substantive duties are required to be undertaken at home. In normal pre-COVID times, this is difficult to demonstrate and cannot be because of the personal choice of the employee. Where it's agreed that there is an objective requirement of the role and substantive duties are required to be undertaken at home, so that home is a workplace, then either the employer can reimburse actual household costs or pay the agreed HMRC tax-free £6 a week or £26 a month allowance, or if the employer chooses not to reimburse those costs, the employee can make a personal claim to HMRC. The second category is where the employer has offered the flexibility and arrangements are in place for the employee to perform some or all of their duties at home. In this case, the employer can reimburse the actual household running costs or pay the agreed tax-free amounts, but the employee cannot ordinarily make a personal claim. It's important to note that HMRC have, however, acknowledged that there may be occasions, such as the current lockdown, where employees are required to work from home, and therefore the rules have been relaxed, certainly for the current tax year, to enable employees to make a direct claim to HMRC where the employer doesn't meet the home running costs of working from home. It's likely, however, that this will be reviewed in subsequent tax years. The other important consideration in relation to home working is the impact on travel and subsistence expenses. Broadly, tax relief will always be due on travel expenses from home to a temporary workplace. The complication arises where there is travel from home to another location that is deemed to be a permanent workplace as well. For example, a location that is deemed to be their workplace in their contract of employment. HMRC make the point that even where it's accepted that home is a workplace for household running expense purposes, the employee will not necessarily be entitled to tax relief for travel from home to a permanent workplace, such as a nominated office. This is on the basis that where the employee lives is generally regarded as a matter of personal choice. However, HMRC do accept that where substantive duties are required to be undertaken from home, and these are as an objective requirement of the job, then relief may be due for travel to another permanent workplace. In summary, I'd say it's really important to review this position very carefully, certainly before reimbursing travel costs for an employee from home to a permanent workplace, unless you've either obtained specific agreement from HMRC or had specific professional advice. Finally, I just want to flag up some other employment-related hot topics that may be of interest. Firstly, the CJRS scheme has of course been extended until 30th of April 2021 and continues to provide valuable support for many employers. The rules are, however, complicated and penalties can be severe. We're aware of increased HMRC compliance activity in relation to claims, as well as issuing of letters in relation to claims, and this is likely to be an area of focus for some time. Separately, there have been significant changes to the tax and NRC rules on termination payments over the last few years. In particular, we've seen the introduction of complicated rules in relation to payments in lieu of notice and the capping of employer NIC relief on qualifying termination payments to £30,000 from 6th of April 2020. It's important that you and your teams have updated your processes and procedures in relation to these matters to ensure ongoing compliance. I'm now going to pass you over to James for some thoughts in relation to the Apprenticeship Levy.
I'm delighted to be able to talk to you today about apprenticeships and the Apprenticeship Levy. My name is James Wybrow and I'm an Associate Director here at RSM. There are many reasons why organisations invest in apprenticeships, and I hope over the next 5 minutes or so to be able to share with you an introduction to apprenticeships, to showcase how employers are utilising apprenticeships, and to leave you with some questions to take away and think about how apprenticeships are currently used within your own business and how you could utilise them moving forward. I wanted to take this opportunity to say that whilst references to the Apprenticeship Levy would lean a focus on employers in England, but I hope you stay with me as I know there are different funding systems in place in Scotland, Wales and Ireland, but apprenticeships are hugely valuable, and I hope much of what we talk through will be appropriate. So, starting at the most recent beginning, being 2017, which represented the most recent change in the apprenticeship landscape through the reform and introduction of the Apprenticeship Levy. The levy was introduced for employers with a UK pay bill of £3 million or higher at a rate of 0.5%, with the monies being placed into a digital levy account which can be only spent on apprenticeship training. Any unused monies is returned to government 24 months after paying in on a first in, first out basis. In England, where employers are below this £3 million threshold, employers must pay the 5% of the apprenticeship training fee, with the remaining 95% funded by the government. Where employers do utilise all of the monies collected through the levy account, these employers also enter into this co-funded arrangement. The levy ring-fenced money and this additional funding, match funding available from the government, presents a real opportunity to invest in the development of apprenticeships. And when I use the term apprenticeship, please always remember that apprenticeship is the apprenticeship training. This slide is taken from the Education and Skills Funding Agency Funding Guidance for Employers and represents a definition of an apprenticeship. I'm keen to highlight that this definition does not make any reference to the apprenticeship's age, the level of qualification of study of the apprenticeship, or the apprenticeship's employment status, highlighting that apprenticeships can be new colleagues within the business, but also utilising and supporting the training and development of existing employees. And this is a point that I will continue to highlight as we go through. I wanted to take the opportunity to highlight some of the key findings from the apprenticeship and employer data collected and reported through the .gov.uk website through its research and statistical returns. This data highlights the different ways in which apprenticeships are used in helping employers and the workforce, and in particular learning and development initiatives. The first box highlights that apprenticeships were offered to all ages, as long as they were over the age of 16 years old. A quarter of the apprenticeships were level 4 or above, where level 4 is the equivalent of a foundation degree level. Apprenticeships such as leadership, management, HR related apprenticeships are included within the business administration and law category, and areas such as manufacturing technician, operatives and automotive within the STEM subject sector area, but those combined account for 58% of all of the apprenticeships started in 2019-20. When reviewing the characteristics of the top 100 employers utilising apprenticeships, they stated that 52% of the apprenticeships were actually existing employees as opposed to new recruits. And finally, that of all of the apprenticeships who completed their apprenticeship, 89% stayed within the business. There are approximately 600 different apprenticeship standards available right now and a further 83 in development. All standards are approved by an independent body called the Institute for Apprenticeships and Technical Education. This body also determines the maximum funding rate any employer can be charged by any training provider for that apprenticeship standard. I hopefully have highlighted that apprenticeship and apprenticeship training should not be considered in isolation, but part of wider workforce planning and learning and development discussions. Many employers currently report having hard to fill vacancies. Employers also cite the possible skills challenges within the existing workforce, leading to apprenticeship training being an ideal solution and opportunity for the employers to take advantage. Where employers have embraced apprenticeship training, they cite a number of positives, in particular referencing how apprenticeships have helped them develop skills relevant to their organisation, have helped them improve their productivity, and improve the quality of the product or service. With many employers not utilising their apprenticeship levy, or employers not taking advantage of the co-investment available from the government, This indicates that employers may not have a clear strategy for how apprenticeships can really add value to their organisation. I hope that these 6 questions will help you in determining whether you are getting the impact your business desires from your apprenticeship strategy. Some of these questions may be easier to answer than others. And whilst all organisations are structured differently, the key question ultimately is, does everybody know their role and responsibility? And this question is the same as to whether or not you have 5 or 500 apprenticeships within your business. It is key to ensure that you have taken the right steps and considered the risks to your business. Risks in terms of, if you are an apprenticeship levy paying employer, the risk of not spending your levy on apprenticeship training and returning the monies as unspent could be significant for you. Having a learning and development plan that requires investment where apprenticeship funding and that co-investment can support you and help you deliver your ambition. Again, can you afford not to take advantage? All organisations have a different maturity, and we detail here some steps. If there are any ways of which we can help, please do not hesitate to get in touch. We would like to take this final opportunity to highlight and promote our Health of the Sector survey. Now in its 14th year, have your say in our annual social housing sector report. Please click here to submit your responses with a closing date of the 5th of February 2021.